Hey, welcome to the podcast, everybody. Thank you for joining me here. This one's coming out a little later than usual. A lot of data to digest. Well, you can see something happened during the day here, and if you were at work and you don't really pay attention to the financial news, which you probably do since you're watching this podcast, but right here, the Fed decision or non-decision came out regarding interest rates, and of course, they're going to keep interest rates low. But the bigger part was the press conference with Bernanke that was there discussing whether or not the Fed would be tapering. And, we've been talking about this the last few podcasts, and a while back I discussed the fact that when this actually begins, the markets will try and digest this, and they will have a hissy fit and go down and adjust to a level. But I think ultimately that will be a buying opportunity, and here's why. If we've been looking at the reasons that the Fed has been putting in quantitative easing, where they're buying billions and billions of dollars of bonds, which keeps interest rates low, puts money in the banking system, and essentially shores up the bank's balance sheets, and theoretically makes it easier for everybody to buy homes and cars and stuff, right? And we buy it from China, and that will help China's economy continue to grow. And we buy stuff from Europe, and that'll help Europe, I was going to say continue to grow, but start to grow. And then that money eventually comes back to the U.S., and that's the idea, right? Well, if you look at all the reasons that the Fed has stated in the past about why they would stop doing that or when they would stop doing that, all the indications that I look at would suggest that they wouldn't be doing that anytime soon, and they would leave interest rates low and continue with quantitative easing. Now you can see the stock market sold off, and before we get into some of the details of tapering, it's such an overused word now, but that's what it's called. The Dow Jones was down 200 points. The S&P was down about 22. The NASDAQ down about 39, all between 1% and 1.5% across the board. The VIX, the volatility index, really did not jump that much today. It was obviously up from the time that this started around 1 o'clock Central Time, but barely finished green on the day. Was basically flat. Some people are saying the VIX had already kind of jumped up a little bit in advance of this as people were buying some protection, traders and whatnot. But here's the deal with quantitative easing, and we'll switch back to the daily picture. So you can see the gyrations the last couple months as this tapering word has been used. It kind of reminds me of when subprime was introduced to the U.S. citizen, and we started hearing this subprime back in 07, 06. Well, tapering is now a very common used word as well, and so everybody's been wondering whether or not the Fed was going to start doing this. And from indications today, it looked like they are going to start doing it. And I've been basically saying I didn't think they were going to do it, and if they did, I thought they would do it over a longer period of time. Now, here's the deal. Looking at the statement today, looking at what Ben Bernanke says, looking at what some analysts that follow the Fed and so forth, everybody's interpretation is that they're going to do it. They're going to start later this year, and they could stop it as early as next year. And they may do that. If they do, though, I don't believe it's because the economy is doing so much better. I don't know what the other reasons would be. Ben Bernanke looks like he may be on the way out the door, and perhaps he's just laying out a game plan saying, hey, I started this deal. I want to wrap it up. I'll let the next person deal with what they're going to, the hand that they're dealt. I don't know. I don't know what the other reasons would be. But the bottom line is, if we look at the reasons they've given for doing quantitative easing, some of those reasons still exist. And, jobs, while getting better, are not great. And certainly, they aren't at their target that they would like. And when you look at inflation, it's at a 50-year low. So that hasn't been an issue. Now, I'm not saying I want them to continue quantitative easing, because here's the deal. The sooner we can get off this, the better, I think. And then that's really what this is about. If you look at the stock market and you're looking at it from an investment standpoint, you're saying, wait a second, let me get this straight again. The Fed has told us they will get off of quantitative easing, stop doing this, if the data supports it, because the risks of a major collapse in the economic system are diminishing. That's good. That's what we want. We want the economy to be getting better and the Fed to get out of the way. That would be good, right? On the other hand, if the data doesn't support this and it gets weaker, the economic data gets weaker, then the Fed's not going to end quantitative easing. They're going to slow down the process. So either way, I think stocks do well in that environment. I think what you're seeing right now, number one, is a Fed day adjustment. The Fed, the day that the Fed usually comes out with their decision, the markets are always go bonkers, right? Usually there's a lot of whipsaw back and forth. This was a very important one for a lot of people because it kind of gave the direction on what they're going to do. Now here's the thing. I was telling one of my advisors this today, not my advisor to me, but one of the advisors that works for me. And I said, look, this would be the same thing as me coming to you and saying, hey, I am 41 years old and I'm going to retire at some point. Now, if I said that to him, would he immediately come to me and say, well, what's going to happen to the company? And what do I need to start looking for another job? Or what's the deal here? No, the fact that I told him at some point I'm going to retire just means I'm laying out a game plan for the future, right? It's years away. I'm not planning on retiring tomorrow. By the Fed coming out at some point, today being that day, and saying, hey, at some point, we're going to scale back these purchases because it's not needed anymore. And in fact, if you look at the diminishing returns of it, they probably should be scaling it back. But all I've been saying is I didn't think they were going to scale it back using their own methodology. The reasons they came up for quantitative easing still exist today. So why would they stop? But standing back and looking at it from a 30,000-foot view, are we in a crisis right now? No. Like we were in 2007? No. And if you look at what's happened in QE1 and 2, interest rates actually went up during those times. And we're not in a crisis, but interest rates went up during those times, and the effectiveness of quantitative easing seems to be diminishing. So they should start to taper off of this. I just didn't think they would do it because they don't make decisions the way I would make decisions. So, and I still don't know if we have any clarity because they're saying out there, we're going to do this. And whether they complete this in 9 months or not, I don't know. Again, if it's data dependent, there's been a lot of mixed data lately that some of it hasn't been so good. So, I don't know the real reason other than the fact that they are bankers, and bankers, they want higher interest rates. So the sooner they can get it, the better. But this has all, to me, a lot of this has been to shore up the banking system, which they have done. Banks' balance sheets are in much better shape than they were a few years ago. And it's because they've got this nice little deal where they can borrow and lend with this, built-in rate there. And go and borrow and invest at a higher rate and make good money. So their balance sheets have been much better. So that's the bottom line to this, is that I think from an investment standpoint, though, the market will get through this because they're not starting tomorrow. They just announced that they're going to do it at some point. But again, talk is cheap, right? Let's see what they do. And if the data gets worse, they're not going to do it sooner than later, I don't think. So if the data does get better, then they should do it. So either way, I think the stock market likes that. This goes back to the David Tepper comments, the big hedge fund manager, who was responsible for some of these rallies, some of these big rallies that have started because of the comments that he said. When he said, hey, if the economy's weak, the Fed's going to be there. If the economy's strong, then the Fed won't be there, but we won't need them because the economy's strong. Either way, it's a good environment for stocks. And that's true. And if interest rates do go up, more money is going to flock to the stock market. So, but what we're seeing right now is a lot of gyration in here, a lot of volatility, a lot of, if you notice here on this picture, a lot of this is intraday movements, these little tails. So we're getting big moves up and down and a lot of reversals and just a lot of volatility where you have, two good days in a row, and then today it wipes out those gains from the last 2 days. You get 2 bad days back here. It bounces up and erases all that about a week ago. So you're getting this, obviously for those that trade very, very short term, you're probably getting whipsawed. That's why I haven't been doing a lot lately other than spreading out a little bit. And spreading out means having some things that produce a lot of income, having some things that move just like the market, having some things that don't move like the market. But on a day like today, not only did stocks go down about 1.5% on the major averages, but if you look at bonds, they went down. Treasuries went down further, which means interest rates went up. Really, the only thing that really worked well today was the U.S. dollar, and it's been going down. So there haven't been a lot of places to hide, and I think one of the most interesting things about the market right now is remember what worked well in some of these other times where we've had markets sell off. Treasuries worked very well as the safety trade, and that right now the safety trade's not there. When the stock market goes down, the bond market doesn't go up. So that's been an interesting little tell. It's kind of like gold. One of the things that we've noticed over the past few months was when gold started going down and there was times where it should have gone up based on some fundamental news, based on some currencies moving, whatever the case may be, and it didn't, that was kind of a tell that maybe it was going lower at some point, and it eventually did. Maybe that's the same thing with treasuries here. There's times where today, you could argue they should have gone down because the Fed may be tapering, but I think they should have gone up because people were getting risk off and would go buy treasuries. And trust me, there's a lot of bond bulls out there who think this is about to reverse and we're going to go back up, and rates themselves are going to go down. So this is the opposite here. This is rates, that they will actually start to go down. I've drawn a little line here at roughly about I think this is 2.4%. So, it looks like it's a foregone conclusion we're going there. We talked about that a couple podcasts ago. We can see that. But remember what's happening here. The Fed is saying the risk of, a big economic slowdown are diminishing. But meanwhile, interest rates have been going up, okay? And really they've been going up since last year. So they're going up, which is going to slow housing, slow consumer purchasing of things. That's happening. And then you have oil prices going up and close to $100 a barrel. I mean, in summer season starting here, and so you're having traveling, and so those two things I think are going to hurt. And meanwhile, the Fed's saying, hey, we're gonna slow tapering, which is going to raise interest rates even further. You can see how they can kind of be in a pickle here. I mean, this isn't a robust economy. Now, is it an economy that's on the verge of a recession? No, I don't think so. I think it's still vulnerable, but I don't think it's on the verge of a recession. All I'm saying is it's not robust enough to completely stop purchasing bonds tomorrow. So they will have to scale it back if they're going to do it. It's just the most fascinating thing to me is the fact that the Fed is looking at all the indicators they look at. None of them are pointing up, and yet the Fed's still talking about tapering. So there's ulterior motives here, and I could speculate on some of them. But bottom line is, I think this market right now is actually a market that is good for stocks and good for bonds. I think it's actually good for both. And the market's kind of throwing a pity party right now because obviously they this just shows you how addicted to stimulus investors are. They're going to take away the punch bowl. Well, A, they're not taking it away tomorrow, and B, they're going to do it gradually. But the market freaked out. We don't want that. Well, let's think about it. The only way this market should keep going down is if it's only going up because of stimulus. And I don't think it's only going up because of stimulus. I think it has a big part of it's because of stimulus. But I think also housing has been better. Auto sales have been better. The retail, consumer, retail stocks, things like that have been good. So it's not all because of stimulus. But on days like today, you can see that there is an addiction to stimulus. So let's see if this bounces back. And I think ultimately, again, I don't see signs that this was the top. This could be the beginning of a summer correction that takes us down to 1,600 again. Could even take us down to the mid-1,500s over time. But I think ultimately this thing still resolves itself because the Fed's still in accommodative mode. Short-term rates aren't going up anytime soon. Remember, they've already given you the formula for that. That's not going up anytime soon. It's the long-term rates we're talking about. Now, what happens when long-term rates go up and short-term rates, so this is long-term rates, but short-term rates stay low? That's called the yield curve, and it actually is steepening right now, which signals a healthier economy, right? Well, financials are the things that should do well in that environment. And so financials are still on my radar because those companies, banks, should do well in that environment where they're able to lend at high rates and they're able to borrow at low rates. Remember, when they borrow, they're borrowing money from you when you buy a CD, and then they lend when you go to borrow money from them to go buy a car or a house. So the difference they make, that's good. That's what they want. So, but it's not all financials necessarily. But financials went down just about what the market did today, so they didn't really outperform. So watch those, though, because that could be, when the market does turn, that could be the thing that starts to rally again. And you can see this little channel that they've been in, back and forth and back and forth and back and forth. So let's watch that. But again, I think the market's still a little confused. And I think it's important that the Fed does throw some of these hints out there that, hey, we're going to start at some point, because they're going to have to say it sooner or later, right? And I think that makes perfect sense. But when are they actually going to do it? How much are they going to do is yet to be determined, because I still think how a lot of it has to do with the data that comes out. And the data so far, to me, hasn't suggested that they would be tapering. But it's, again, there's plenty of arguments to say it's been ineffective, especially QE3. So, but ultimately, I think the stock market will go higher through some gyrations here. But just don't be a hero and go all in just because I'm saying that. I mean, you have to still have your systems in place. So even though I say I think ultimately stocks go higher, if I'm wrong, my systems would tell me, and there would be exit strategies for a lot of different positions. Okay, but right now you have to put up with a little volatility, because you're not going to get anywhere if you can't accept some volatility. Otherwise, you're going to have to go into a whole different ballgame. And volatility really right now is covering all areas, isn't it? It's covering gold, it's covering stocks, it's covering bonds, it's covering currencies, it's covering, you name it. Volatility, the actual volatility itself is volatile. So you're getting asset class. There's a lot of movement on every word, on every rumor of will they or won't they. All that stuff is happening, and things are bouncing around. And so you can reduce your volatility by obviously having some cash, some income, spreading out a little bit. You can reduce your volatility by being in cash, or you can increase your volatility by just staying the course and being in a broad basket of mutual funds, and you're gonna actually increase your volatility, and trading too much will increase your volatility. So you have to decide what you want to do. And I think right now, obviously the market's in a transition phase. You're seeing some of these things like the moving averages here. Like for example, the 50 days still pointing up. All these major averages are still pointing up. The 20 days kind of moving sideways, and it did here, and then it finally took off again. So I think we're just digesting this. The market is going to have to get used to the Fed tapering at some point. I just, again, think the most interesting thing is, why are they really doing it? Because if we know the Fed's not logical, they have some motive. Is it because Bernanke's leaving? And is it because, they don't think it's effective anymore? I don't know, but all the reasons we know that they have put in QE, and all the indicators they look at are pointing to that they would continue QE. So, but again, don't base your life on quantitative easing. If you're investing because the Fed's doing quantitative easing, and that's your rationale for being invested in the market, then yeah, you're going to be disappointed over the long run. So you got to have a plan. I think you have to, again, when we talk about portfolios, break the portfolio down in pieces. Here's the piece I'm going to keep no matter what. Here's the piece I'm going to get out based on certain conditions. Here's the piece I have for income. Here's some cash I have to buy some of these dips. Those are the things you have to do to build a portfolio. But right now what's happened is it's so volatile. It's really hard. I mean, even stuff that's supposed to be not volatile right now is volatile, right? Whether it's consumer staple stocks or bonds, I mean, those things are volatile right now. So you have elevated volatility all over the place. And again, this stuff will shake out, but right now you're just seeing a lot of choppiness. So don't get whipsawed is the bottom line. All right, folks, thanks for the questions, the comments, all those things that you send. We're on karleggers.com. free subscription up in the top right. We're on eggerscapital.com, the money management website. We're on Facebook, Twitter, iTunes. What else are we on? Google Plus. We're on there as well. Twitter, @Karl Eggs is the handle there. So thank you very much, and have a wonderful evening.